A very warm good afternoon to all of you. It's with a genuine sense of enthusiasm and honor that we present to you the latest edition of Netra, the August edition. With a constant stream of massive data coming in, day out, considering today's just released RBI policy, the central bank uh, maintaining a pause in response to the headline inflation increasing, and the buzz around tomorrow's US inflation announcement, and also not to forget the Nifty's roller coaster around the 19,500 range. It's evident that we have quite a substantial feast of information before us, right? Now, guiding us through all of this complexity is none other than Sahil Kapoor, the brilliant mind behind this highly regarded report. Sahil Kapoor's knack lies in his ability to meticulously decode all the finer aspects, be it anticipation around the services export being at the mercy of global slowdown, the global inflation trajectory in the coming periods to the potential adjustments in the Indian markets. He's our go-to expert who will help us navigate through the sea of economic happenings and insights. Over to you, Sahil.
Thank you, Pragati, and good afternoon, everybody, and welcome to this August call for DSP Netra. And we've been, doing this call for the last few months now. And in this edition, we've tried to highlight some very, very important aspects. And last two, three editions, we were largely focusing on a number of long-term important indicators. This time, we've looked up at a few indicators which we think are just around the corner and trying to turn a corner, and we'll discuss that. So, as you know, that we come out with this report every fifth of the month, and we are possibly going to chat about all the important charts that we put out this time also. So without any further ado, I will share the screen and we'll get going on the presentation. As Pragati said, you can ask your questions in the Q&A tab, and once I finish, we'll take up all the questions which are there, which you put out in the Q&A tab. So two, three very key important insights. You can access the report from website. Go to dspim.com and go to the tools and resources section. There you will find all the present and past reports for Netra and also other collateral that we print. So this time, what we are focusing on is a global growth slowdown and valuations and opportunity. There is I think, a lot of debate going around whether there is, slowdown happening or not. And recently, I heard a number of global firms talking about US not into slipping into a recession, etc. So although we have no idea how these things will pan out or whether US will slip into a recession or not, there are no real use cases of indicators trying to predict that. But what we've looked at is a number of key indicators. So one, if you look at on the top left side of your screen, what we've shown is that what is happening in US. So as you know that over the last few months, we've discussed that services economy in US has been quite strong, right? And you can see on your screen that this blue line at the back is US real services consumption, right? So services sector in US has been quite strong. But on the contrary, the manufacturing PMI, if you can see, that has slipped quite a lot, right? That PMI has slipped quite a lot, and it has gone and gone below the previous trend that we saw post COVID. What we've seen historically is that manufacturing sector leads the services sector by about 6 months. And I think we are already in the seventh or eighth month where services sector has diverged from US manufacturing. That means services hasn't slowed down yet. But when we look at some indicators that are available from the services sector, we think that there is a sign that services economy will also slow down in US. Some of these indicators are from employment. For example, the last non-farm payroll number that you saw is now below 200,000 jobs a month. And I think slowly it is very gradually it is trying to come off. When you look at even other services indicators in terms of services PMI, and if you look at the new orders and other numbers, some of those numbers have started to come in softer, right? So our expectation is that over the next 6 months, this needs to be closely monitored. There could be a further slowdown. The manufacturing economy is already manufacturing sector in US is already under a spell of a slowdown, and services could also go and slow. Secondly, if you look at lending standards in the United States, lending standards are very, very tight. What does this mean? So if you look at this bank lending standards, let me magnify it a little. And if you look at this chart on the screen, it tells you that when this black line is falling, it goes to close to zero. That means lending standards are very very tight in US, which means that it is very difficult for borrowers to borrow money, right? And that becomes a bit difficult for credit growth to continue. And that I think is a sort of a concern which is happening right now. And what we've seen historically is that whenever credit, standards tighten, at that point we see loan growth also slows down. So you can see historically what has happened is whenever, so for example, look at this global financial crisis or the post, the bubble bust in 2000, which is the dot-com crash, right? And similarly, in other instances where when credit standards or lending standards are very, very tight, loan growth slowed down. And usually, a slowdown in loan growth will get reflected in services economy because very large part of US economy is services based, right? So this number is most likely sort of some amount of lead indication in this number, and there is a possibility that over the next 6 months it will get reflected. Third, if you look at one very strong support for global economy was a very large stimulus in US, right? So if you look at the excess savings in US had jumped up significantly. You can see this number from 1.5 trillion went to 6 trillion and then it collapsed, right? This is where the US government gave, dollar checks to US citizens after, the COVID restrictions were there, right? The COVID restrictions were imposed. And since then, we've seen that the excess savings have now completely burned out, and the support that it was giving consumption is no longer available, right? So right now, you have a scenario where credit growth could slow down, and the excess consumption which was happening because of excess savings, that is also not available as a support. Fourth is similar trend is available in Eurozone also, where Euro area bank loans have started to slip. Lending survey, if you look at ECB bank lending survey, that is also telling you that loan growth in Euro area is also going to slow down, which again reflects that growth in Eurozone, which is already very weak. We know that 2, 3 countries have already reported recession in Eurozone. So one clear sign from this is that Eurozone and US both are witnessing a possible growth slowdown in the next few months. And so when you look at the global economy and if you put it together, it's about $100 trillion. US is 26 trillion, Eurozone is around 22, 23 trillion, and China another 18 trillion. So when you add them up, two-thirds of the global economy is explained by these three groupings: US, Eurozone, and China. And we spoke about Eurozone and US. Now let's look at China, right? Look at a few numbers from China. Industrial profits in China have started to dip, they have become negative. Inflation at the wholesale level in China has turned out to be deflationary now. It has turned to deflation. Even China consumer price index, India CPI, as RBI said today, could be around 6.5%, for the month of July. But Chinese CPI is now 0%. It has started to slip, and disinflation is now possibly turning to deflation, which is again a sign that growth is very weak. Just about 6 months ago, people were talking about a very big boom because of China reopen. So that doesn't appear to be number anymore. Similarly, Chinese credit growth has started to slow down again. Chinese credit growth used to be plus 15% in 2010 era. It dipped to 10%, post COVID because of the COVID restrictions. Again, it, surged quite a bit because of the reopen, and again, it has started to slip back, which is again a cause of a concern for China. And you know that China is talking about giving a stimulus, but for now, it appears that mostly it has refrained from giving any significant monetary support. It's only talking about reforms and giving stimulus, but although it's not constituting a very large number. Third is retail sales. Again, we saw a surge. Again, they have come down. Now they are now going below 6 months moving average. China retail sales again, which is a sort of a drag for households in US. Household consumption in China is not as strong as it used to be earlier. So from pre-COVID levels where it used to grow at 10%, it has become a lot more volatile, and now it has started to slip below mid single-digit numbers. Right. Last is petroleum products usage. Again, a very, very important indicator. Usually in China, petroleum product usage doesn't degrow on a YY basis. Only during COVID did it degrow, and during the last slowdown, which happened after 2014 in China. This time again, we are seeing that it has started to degrow, which is again a sign that Chinese growth is not very strong. So this tells you that three major global engines of growth, US, Eurozone, and China, are either already slowing down or there are signs that these three economies will slow down as we go ahead. Third is we've seen that globally inflation in many parts of the world has been very high, and the headline inflation in many countries has gone down. So if you look at this on your screen, you will see that there are G7 countries put here, and all these countries we put blue line, which is the headline consumer price inflation, and the orange line, which is the core inflation. Minus the food and fuel number. And you will see that in many countries, the headline inflation has started to fall. For example, in Canada, in US, in G7 as a totality, in Italy, in Germany, in France and UK and Japan, it has not come down as much. In Japan, it did not even rise as much, but for other countries, it went up quite a lot and it has started to come down. Although in most of these countries, it remains well above the pre-COVID levels. You can see that it's still very high. Our sense is that these numbers will slip, and if the hypothesis on growth is correct, then most likely core inflation will also come down. And this is, I think, departure from the current narrative in the market. Currently, what people believe is that A, growth is strong, B, numbers are strong, C, that core inflation could move higher because growth is much stronger than anticipated. The data that we are watching today tells us that over the next 6 months, these numbers could slip. So I think there is a real case for believing that growth in some parts of the world, specifically in these three very large and important groupings, could see a slowdown, and that will also cause the core inflation, which is, I think, what many central banks are talking today. That will also start coming down in the next 6 months. We don't have a crystal ball to say which month, but there is a good possibility that this data has already started to tell you that the time for this to turn has already come. The next is that India has enjoyed a very strong spell of services exports. And that has happened because global economy recovered quite swiftly after the COVID crisis. Very large stimulus given in US, Eurozone, Japan, other economies that helped India by the way of net services exports. So you can see that this red bars, if you see very closely, our net services exports rose very, very strongly, nearly 20-25% CAGR over the last 3 years, right? This is the YOY number, the red dark red line, dark red bar, and the blue is our nominal GDP growth, right? So you can see when nominal GDP was rising by 18-16%, net services exports were growing at 22 and 44%. So although the base was not very adverse, right? It was not that our services export grew on a poor base. They were actually rising on a very strong base, right? And this is why you see the lower end, the chart at the bottom. It shows the contribution of net services exports to nominal GDP, which means that if India's GDP is, let's say, 300 lakh crores or 300 trillion rupees, okay, and if it grows 10%, that means it adds 30 trillion and goes to from 300 to 330 trillion rupees. In that 30 trillion additional, 1.5% came from only services exports. So very large contribution from services exports, and this contribution used to be uh, you know uh, 50 bips or 30 basis points. So you can see this number used to be much smaller. Last 2-3 years, this number has gone up significantly, right? Because the numbers have changed dramatically. And there are two parts of this number. One is our IT services exports, which have grown at 15% CAGR. And the other and more important part is very strong rise in our professional services exports. So what we are today calling Global Capability Center or GCCs. A number of these GCCs have been, which were there earlier also, but now they have become much more clearer because of clarity on taxation. And a large number of organizations are now outsourcing their internal work, right? For example, a very large investment bank from US, which used to have huge operations, back-end operations in US, has completely put that offshore to India, and all that operations are now operating out of India and generating huge amount of dollar inflow for India, right? So that is also a very large contributor. Today, what we are seeing is that if there is a global slowdown, there is a possibility that a very large chunk of IT services exports, which has grown at 15% CAGR, could go back to its normal growth rate of 5-6%, okay, which is the longer term trend for that number. So we think that that risk could, happen here, and it could contribute to some slowdown for India. But this is still an hypothesis, but I think it has a lot of linkages. It has linkages to our IT companies, which I will speak about, which I have charts at the later end. And it also has importance for the overall growth number for India. So this is one risk area that we are witnessing, although it has not fructified. But if you are following my line of thought from slide number one, there is a possibility that this risk could come about in the next 6 months or 1 year. The next is that domestically, when you look at only India specific growth numbers, most numbers remain very, very steady. GST collections are still at, rising at 10-11% YOY every month. Very strong number. Although when WPI is negative, GST collections haven't really, gone down. So tax collections are strong. E-way bill, which is already hitting lifetime high, is consolidating at all-time high number. Fast-tag collection is also at all-time high number. Volume of petroleum products sold, again, one of my favorite indicators, continues to remain at close to lifetime high. PMI for both manufacturing and services continues to remain at all-time high. So domestic indicator of growth are showing no signs of a slowdown as of today. The risk is only coming from what I showed on the last slide, some international linkages. So if you remember last year, in some of these calls, we clearly spoke about that how Indian growth is diverging while the globe is, sort of patchy. Some countries are slowing, some countries are accelerating. India data was accelerating at the fast pace. Today, again, we are seeing that India data remains steady, but only the domestic data. The global linkage, which did not impact us so much last year, is something that we need to watch out for the next 6 months to 1 year. That is something where there is a source of risk. Domestic economy continues to be very steady. In fact, when we speak to number of sectoral companies, the sense is that these numbers are still robust. Urban demand still remains very, very robust without showing any signs of let up. Right. The next is that India still has one more vulnerability, which although hasn't really shown up in numbers, but it could. Right, we've seen that what has happened with vegetable prices in India. Tomato prices went through the roof, rising 1400% adjusted basis, which has caused inflation to move up by around 130, 140 basis points. So, for example, if inflation were to be at 4.85%, it is now at 6.3 for the month of July. And the reason is that very high increase in some of the low weightage item within the CPI basket. Although they are very seasonal factors, they happen every year, but they do contribute to some amount of volatility in prices. RBI will also see through it, right? There is no stickiness to it. Once the new crop comes in or new harvest comes in, prices will again fall, right? And we've seen in some parts of India, prices have already started to fall. But when you look at India's CPI basket, if you look at this chart on your screen, it has three important parameters. One is the weight of food articles in CPI basket. So what is the weight of food in our inflation? India's weight is close to 46.5%, one of the highest weights across countries. Although we import very less food. So this axis is how much imports do we do. Food imports as a percentage of total imports. So our food imports are very small. We don't import a lot of food. So our local inflation, although global factors also do cause prices to move, but to some extent, India is able to control some of the food inflation domestically, right? Second is the size of the economy, or the size of the bubble is the GDP per capita, right? So Indian GDP per capita is very small, and largely because we have low disposable income. What does this chart mean? This means that because we are an economy which is not very, let's say, we are not a rich economy on a per capita basis, we are still, much below average. Because the weightage of food is very high in the basket, India is very vulnerable to volatility in food prices, right? And we have seen one or two signs with grain deal breaking up between Russia and Ukraine. Vegetable oil prices rising, olive oil prices rising globally. So we are seeing some signs that there is some volatility which has creeped in, and we need to be more vigilant about these things in the next 1 or 2 quarters. For now, it does seem very, very transient and temporary, but I think this is something that we are vulnerable to. And RBI has also sort of pointed it out today about price volatility. Most likely, we'll see it through, but I think this is something that we are watching carefully. Although there is no actionable on this item as of now. The next is some of our valuations and views on markets and sectors. One is very clearly that the global liquidity has now diverged, right? So if you remember last year, central banks started to do quantitative tightening. So if you look at there are two lines. One is G for central bank balance sheet, so which is the black line, and the other is orange line or the brown line, which is the MSCI World Index. So MSCI World Index is YOY, right? It's YOY return every month. And the black line is also the change in the balance sheet. For example, if you're looking at the data for August, it is August of last year versus August of this year, right? So when the black line is rising, which means that central banks are putting in more liquidity, they are increasing liquidity in the system, which is allowing their balance sheets to expand, what you call money printing or liquidity injection, right? What we are seeing is that liquidity injection went down, they reduced, and then they reversed, what we call quantitative tightening. Central banks started to reduce the size of their balance sheet, right? And this caused some amount of equity correction. But recently, if you look very closely, let me expand this graph. In the beginning of this year, there was SVB crisis, right? And rather than decreasing the size of the balance sheet, central banks actually infused more liquidity to go away and to blunt the impact of that crisis. And we saw a very sharp rally in equity markets globally. For the first time, what we are seeing is something very, very important. And please hear this view very clearly. Central banks are now again doing quantitative tightening. That means they are squeezing out liquidity, but they are doing it at a time when interest rates are high in comparison to what they were doing earlier, right? So in all the prior instances where they did quantitative tightening, there is only one instance, which is 2018. Equity markets were very, very lackluster, right? They were not doing anything. In the present episode, we have not seen a very clear quantitative tightening happen until now. Because when they began tightening and raising interest rates, you had the banking episode in US, which pushed all the central banks to go the other way. That means again do some amount of liquidity injection. Now what they're doing is, they have already raised rates and rates are at high level. Now they're actually doing quantitative tightening, which they haven't done until now, to my understanding. And I think this is possibly going to pull down a number of global indices, specifically indices which are slightly or quite a lot above their average valuations. So, for example, just to give you 2, 3 data points, when last time the quantitative tightening cycle began in 2018, S&P 500, which is the US index, its price to earnings multiple fell from 19 times to 15 and a half times, right? This time, when they did quantitative tightening, so to speak, and then they reintroduced some amount of QE, the multiple expanded from 15 and a half times to 19 times. So it is sort of a divergence and which has played out. How I look at this data is, in the real essence, quantitative tightening actually did not happen at all, and this I think is just the beginning of that happening. And this has the capacity or the ability to pull down valuations, specifically in US and Eurozone, where we have seen a sort of a extended rally, specifically in technology space. And I will talk about that. I have a slide for that. So the conclusion from this slide is that liquidity tightness that we are seeing globally, and of course we are seeing of partly that happen in India also, that could pull down equity markets in the second half of this year. How much? I think US can undergo a larger correction. I don't have a number, so to speak, but I think correction could stretch maybe beyond 10% or so for US and Eurozone. But what could be the impact on India? That we'll see in the next 2 slides. So first is that domestically, we've seen valuations have again gotten stretched, right? We had this 5-month rally in India, which was 12-13%. If you remember, in the same call in the month of March, we told all of you that 17,000 or lower Nifty is a very good time to build equity exposure and raise your equity weights, right? Now close to 20,000 levels, 19,600, 700, 20,000 levels, we believe that markets have become a slightly frothy. Valuations are a little stretched. Particularly, Nifty is now trading at 22 times or 22 and a half time price to trailing earnings. We feel that the margin of safety is now low. And given that there is a possibility of a global correction and also some linkages that could seep through domestically, we think that markets could take a short-term dip or a breather, and it could dip to maybe the previous highs of 18,600 or maybe go back to their 200 DMA of 18,200 or so. So we feel that some correction is possible. But at the same time, what we also feel is that Indian correction could be shallower, right? Correction in other parts of the world could be much larger. And the reason for that is our domestic numbers remain much more resilient. The economy remains much more resilient. Liquidity conditions are also better in India, right? So even if you have to consolidate and see valuations become more attractive, uh, Indian equity market could see a shallower correction, a lesser correction than other markets, but a possibility of a correction cannot be ruled out. Second is that, as I've written here, a correction within a larger uptrend. If you look at this table very clearly, what we are showing here is that in the last few years, whatever rallies have happened globally, India has seen one of the highest earnings growth. So if you see EPS growth in India, 69%, right? For all other countries, the EPS growth has been much lesser. In case of Germany, it has been 64, very, very strong. And in case of Taiwan, 58%. So these two are the trailing numbers after India. And you can see that India has also seen same kind of equity performance. So we haven't really seen a large expansion of our PE multiple. And the reason for that is that our multiples are already very, very expanded. They are very high, right? We are trading at 22, 23 times. So the room to have a re-rating from where we stand today or to expand our PE multiples is not available, right? So the only parameter that the markets will look forward to is earnings growth. And for many other countries, this parameter, which is the EPS growth, is becoming questionable. For India, it is not so much. For India, the earnings trajectory is still stronger at 12-13% to our understanding. But we believe that for many other countries, that is becoming questionable. And that could be the cause of correction, and which will cause some amount of correction in India also, although shallower, but it is quite possible. So the view is that there could be a correction within a larger uptrend, but correction nonetheless domestically and globally. Next is our view on a few sectors. Indian IT, I think, has been a well debated sector. What we believe is that two, three things are happening. One, if you look at this black line, which is the PE ratio for the sector put together, it still remains well above the pre-COVID levels. So prior to COVID, the PE ratio was much higher than what it is today. Post COVID, we had a huge amount of rally, largely driven by very strong earnings growth. So you can see EPS growth started to touch about 30-35%. And price to earnings ratio also touched 35-40. Now the earnings growth for IT companies put together is now close to slipping into the negative territory, right? So the PE multiple is still higher than the prior multiples that we used to see pre-COVID. Secondly, the margins picture, which went and improved from about 20-22% on a blended basis to about 27-28%, they are now back to about 20%. We believe that in the next quarter or two, if this number slows down further, this is what many companies are guiding for, we could see IT stocks correct even more. And that is how we are seeing this sector. There is a possibility that we'll see another round of correction before this sector becomes much more attractive. If it corrects and gets back to its long-term averages, I think the long-term story remains very, very juicy for this sector, and then we'll see some opportunities. But in the short term, the outlook remains very uncertain, and we feel that there are more headwinds which could cause this sector to correct even more. The next is global technology on the same lines as I showed you earlier. So four charts here. One is that some of the larger technology companies and the larger companies have become 29% of the overall weightage of S&P 500, which is an all-time high. So, which is higher than even 2021 peak, right? What we are seeing is that some part of the market, for example, semiconductors, have reached levels that we haven't seen. So EV to EBITDA, they have become as expensive that we've ever seen them, barring the 2009 revival where earnings were completely absent, right? So markets, these are trailing numbers, right? So they became very expensive on trailing basis, but I think this is not the true picture. On a true trailing earning basis or smoothened earning basis, semiconductors have become one of the most expensive that they have ever been. And similarly for Nasdaq, if you see, the PE multiples have again expanded to 25 to 27 range. Price to sales have gone back to 4.5 times, which is very, very high. And we haven't seen these multiples other than during COVID, right? During that COVID boom where earnings were depressed and huge stimulus was available. So we believe that these are some signs that there is some froth which has gotten built up in global technology, specifically in the large cap space. Right, mid and small cap are extremely cheap in US in comparison to large cap. So we believe that this is another reason why markets could, take a breather, pause, correct, specifically these larger names, and they also face a lot of risk of maybe short term some of these newses and noise, creating some correction for them, although they have no bearing on the longer term trend for these companies. But the valuation froth has gotten to one of the extreme readings that we've seen recently. The next is on PV, and we've highlighted this for last 1.5 years. Auto remains one of our key bet, and what we've seen is that recently the auto sector numbers have gone up, and we've seen that the longer term trend has improved, and the 3-year CAGR growth for PV sales has gone back to the long term average. So the last time PV sales on a 3-year CAGR basis was growing at 10% was back in 2012, right? And this is after 10 years gap that we are seeing that number has gone back to that trend level. So there is now a case for numbers to improve for an extended period. But we believe that two-wheelers are a better bet because of valuations right now. Passenger vehicles, although continues to remain a focus area for us, but valuation wise, I think it has become very bottoms up. You can't paint them all with the same brush. Two-wheelers is a better space in comparison to PVs, but this sector remains a very important bet. And we believe that if a correction ensues, some of the sectors that we've been betting on, including BFSI, two-wheelers, some part of PVs, healthcare, will be one of the better sectors to increase our allocation when the correction sets in. The next one is gold mining, and this is the last slide from the ideas that we have. And we've seen that gold has outperformed S&P 500, but all of that outperformance came in the first half of 21st century, first decade of 21st century. Since then, it has done nothing. Gold has been flat. We haven't seen anything which has happened. And 2, 3 key reasons is for gold mining companies to do well, which is our hypothesis here. So what is the hypothesis in this slide? One, we are seeing that if gold prices break to a lifetime high, gold mining companies could do very well. And what is the reason? This time, gold mining companies have a much better capex discipline. They have not spent money right, left, and center. In fact, they are now net debt positive. Second, they suffered quite a lot in 2022 because of higher energy cost. Because of that, their ROICs were very depressed. This year, it's been much better, right? Those numbers have started to improve. Third is that on all valuation parameters, gold miners are much more cheaper than the broader market. On EV to EBITDA, they are low. Gold miners, 2/3 as expensive, right? So 1/3 less expensive than the broader market. Dividend yield is higher. Net debt to EBITDA is lower than the market. Total debt is also lower than the market, right? So overall, they are less levered than they have been historically. What they need is a gold bull market. And our expectation is that we could see a gold bull market going ahead, and that could cause mining stocks to do very, very well. And this is something which hasn't happened till now, hasn't happened even in the last 10 years. But our hypothesis is that gold could enter a bull market, and if it does, gold mining will be a very large beneficiary, and the sector could get a very strong re-rating. So these are the few slides, and let me recount what we've learned till now, and then I'll go to the one last slide, the behavioral slide that we put in all the publications that we do. So from the beginning, what we've seen, what we are saying in this edition is that global growth in US, Eurozone, and China could see a slowdown. We are already seeing signs that US and Eurozone growth is slipping, although gradually. In next 6 months to 9 months, we'll see that growth could soften up. And same is the case in China, where indications are that they will need a stimulus. If they don't give a stimulus, growth will slip further. Third is that inflation, which is core inflation, which is the key ingredient for all central banks to change their stance, that could also slip as we move ahead, right? For now, it is very, very sticky in many countries, as you can see on your graphs. Headline inflation has already turned. We believe that maybe next 2 months, inflation could see some uptick in US and Eurozone. But on the whole, next 6 months, we'll see that because growth will slow, which is our hypothesis in the first four slides, you will see that core inflation will also slip lower. And if the global growth slowdown is real, if it happens, it could also hurt India's services exports, largely IT exports, because other part is mostly immune, and that could also cause maybe half a basis point slower growth in India. It is just a hypothesis right now, but this could happen. Next is that domestic indicator for Indian economy remains very strong. We haven't seen any let up, and that is also a differentiating factor why Indian growth is much more superior, and possibly even if there is a global correction for India, it would be shallower. Next, of course, is our vulnerability to high food prices, which I explained. And then I explained very clearly that global equities are at a risk because QT or quantitative tightening has now begun in earnest. It didn't begin in earnest earlier. I think this is the first time that it is happening, and this will cause some amount of taking out of liquidity and compression of multiples across the world. Domestically, also we are seeing valuations are a little stretched. We need to consolidate, possibly closer to 18, 18 and a half Nifty will be a good time to look at equity allocation and increase them. For now, I think it is more staggered and a more cautious approach. Um, and then I discussed outlook on IT, where we feel margins is a very, very important monitorable, and there is possibility that the sector corrects before it starts going higher. So again, we need to watch very carefully next 2-3 quarters. Similarly, global technology, where we are seeing signs of froth in specifically large caps and semis, where we could see some correction. And then we spoke about PVs and auto, why it's a long-term story, and two-wheelers could be much better. Some froth in some PV names, but overall, longer-term trends have improved. And then we spoke about gold mining. And the idea is that if there is a gold bull market, gold mining could benefit a lot. And the last slide that we put is from Safal Niveshak. We've taken it from him, and what he says is that if you look at this, the pug marks and the foot marks, there is this guy who takes out his dog every day from Columbus Circle, and he goes to Metropolitan Museum, and you can see that every day he takes the same route and goes to the museum from the circle, right? But the dog takes a different route because the leash allows the dog to go anywhere it wants until the leash allows, right? So this is the stock market, right, which is the dog, and the where the owner is going is the earnings, right? So eventually the market will follow the earning, but sometimes we get caught up in these short term aberrations because they cause the mean to go they cause the prices to go away from earnings, right? And currently we are maybe witnessing these phases where slightly valuations have become slightly frothy, and we could see some reversal. So the idea is to follow where the earnings are going. For India, the earnings are growing. Longer term picture remains very strong, but in the short term, we think that slowdown and some of these factors could weigh on the equity markets. So with this, I think I will stop here.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.